In the previous chapter, we talked about how you would account for how you would do a consolidation when the subsidiary is 100% owned. And let's explain now how it's different if there's a non-controlling interest. As long as there's a controlling interest, in other words, the parent has control, then the parent needs to consolidate. So that doesn't necessarily mean that the parent owns 100% of the sub. The parent merely needs to own enough of the sub in order to have control, whatever that is, as we said. Shareholders of the sub who are not the parent are called the non-controlling shareholders, or the non-controlling interest, and that's the NCI over here. So the parent owns a certain percentage, and then the rest of the sub is owned by somebody else, and that's called the non-controlling interest. And in this case, there are voting shares that are owned by someone else, and in the old days, this was called a minority interest. Now, I used to have a client that when I worked in the real world of accounting, I had a client, a country club. And what the country club did was it was in a fancy, very expensive part of Westchester. And in the 1960s and 70s, this area was getting developed. And most of the members of the country club lived in the neighborhood. And slowly, some people who lived in the neighborhood were selling their estates. It was a very fancy area. And developers were buying the estates, and they were going to develop these into subdivisions. And then more people would move into the neighborhood, and it would become populated, and before you know it, it's not a fancy estate neighborhood anymore. They wanted to stop it. So what they did was, the local neighbors, who were also members of the country club, chipped in with the country club itself and bought these properties. And they bought them on the pretense that they were going to be investments. They would stay as part of the country club, but they were also investments that would be sold eventually when property values increased. And by that time, the neighborhood would be preserved, and the country club, to protect the neighborhood, would only sell properties to people who it knew were going to preserve them properly, i.e. keep these estates in place and not subdivide them. So they created a partnership, and 60+% was owned by the country club itself, and the remaining, about 2/3 was the country club, and 1/3 were all these members of the country club and who also happens to live in the neighborhood. So what you might do is let's say the estate next to yours is up for sale. What you do is you'd invest maybe $100,000. The country club would spend like $200,000, and they would buy that property. And the property is right next to the country club, so it makes sense for the country club also. And maybe one day they'd build a golf course there. Who knows what they're going to do with it? The most important thing, of course, is that we don't want a subdivision there and have less affluent people move into our neighborhood. So that's how it happened. So I was there like in the 1990s, like 25 years later. And now this was some of the most expensive, valuable property in the country. And the people who made the original investments, they all were passed on, and their children now inherited these investments, the non-controlling interest in this partnership. So again, remember the partnership, 2/3 of it belongs to the country club, 1/3 belongs to individual investors. So the country club is controlled by people in the neighborhood, and also some people outside the neighborhood. The people in the neighborhood really like to have all this open space. And it turns out that these estates are doing just fine when they're empty. And the best thing you can do is not have any neighbors at all. So the people who are members of the country club, they're quite happy with the way things are, because over time these estates have sort of just been left to rot. and it's just open space, which they really like in their neighborhood. They don't have any neighbors. And the country club is pretty okay with leaving things the way they are. Meanwhile, the children of the investors who are in the non-controlling interest want to sell the property, because if they sell the property, there's millions of dollars here. This is some of the most valuable real estate any place, and each of these estates is worth millions and millions and millions of dollars. So if the country club would just sell some of these properties, then a third of the profits would go to these investors who are the children of the people who used to live in the neighborhood and they were members of the country club. And so they stand to make millions and millions of dollars. But the country club has the controlling interest in the partnership. And the country club does not want to sell any of the properties. And so the non-controlling interest is stuck. Now they're suing them. They were suing them and they got them to sell some of the properties. But overall, they're pretty much stuck. And that's what it's like to be a non-controlling interest. Because you could be in the board room and there's 6 representatives of the controlling interest, and there's 3 representatives of the non-controlling interest, and the 3 representatives can jump up and down and they can stand on their head and they can yell and scream all they want, but they only have 3 votes when the board makes a decision. And the parent has 6 votes. So they could do and they could say whatever they want. They do have certain rights. They have the right to audited financial statements, in essence, to inspect the books. They have the right to vote. But that doesn't mean they have the right to win a vote and get what they want. So being a non-controlling interest is not necessarily fun. But if you're a parent, it's a great way to finance your business, because non-controlling interest has less rights than even bondholders. You don't have to pay them interest. They can't foreclose on your property. You can't just shift money away from the partnership, from the subsidiary into the parent. You just can't take the money. But you have control over their policy decisions. Now, there's a question whether you should consolidate 100% of the sub or only the percentage of the sub you own. So let's say we have a situation here where the parent owns 80%. I can't change that. I wish I could. The parent owns 80% and the non-controlling interest owns 20%. Here's the question. Should you consolidate the whole sub, or should you only consolidate the 80% of the sub that you own? And when you think about it, consolidating only the 80% that you own makes a lot of sense. Because if you do that, you don't have to worry about the non-controlling interest. Let's say you have a sub and they only have cash. They have $100,000. And 80% of that belongs to you. That means you have a sub worth $80,000 in essence. And that's called proportional consolidation. And the alternative would be full consolidation, where you consolidate the whole sub regardless of what percentage that you own. And that's a lot more complicated, because then you have to report this non-controlling interest. And in fact, that's GAAP. Full consolidation is GAAP. And that's what you have to follow. But it's much more complicated. Why do we use full consolidation? Because it better presents the real status of the company, the real financial position of the company. Therefore, there's going to be 2 accounts, 2 line items in your consolidated financial statements that will report the non-controlling interest. On the income statement, what you've got to do is you've got to report the non-controlling interest in the net income of the subsidiary. And that's a mouthful. I never found a way to abbreviate it, to make it simpler. The non-controlling interest in net income of the sub. And in essence, what this says is that for every dollar that the sub makes, a certain percentage of that belongs to non-controlling interest. So that's like an expense, because it doesn't belong to the parent. So when the parent consolidates, it needs to set aside a non-controlling interest in the net income of the sub, and that's the income of the sub that doesn't belong to the parent. Then there's also non-controlling interest in net assets of the sub. And this would be for the balance sheet, because you have to record all the assets of the sub. You've got to record all the liabilities, but all the equity doesn't belong to you. Part of the equity belongs to somebody else. So a piece of that subsidiary that you control belongs to somebody else. And that would be net assets on our balance sheet that don't belong to us. Now, historically, this has been very controversial. The question was should the portion of the portion of the subsidiary that doesn't belong to us, that is the non-controlling interest in net assets, is that a liability? Is it stockholders' equity? Or is it something in between? And under the old rules, you could report it in any one of these three ways. It could be reported as a liability. It could be reported in what they call the mezzanine, which is like in between. Like, it's not a liability, it's not stockholders' equity. We're just going to stick it in the middle. So they would report it under liabilities, but before stockholders' equity. And the new rules say, not so new, they're like about, I think like 10 years old, that it's part of stockholders' equity. So one of the items that you're going to report in stockholders' equity, it's usually going to go down below in under treasury. Might have other stockholders' equity. One item is other comprehensive income items. Also there would be treasury stock and non-controlling interest. It's an interesting point of trivia here. If you look at most companies' balance sheets, they never add up. They very rarely add up total liabilities. So what you usually see is total current liabilities. Then you'll see a list of the non-current liabilities. And then it goes straight to stockholders' equity. And you can look at 95% of companies' balance sheets don't report total liabilities. And my theory why this is because of this. That what they would do is they would report non-current liabilities, and then they would report non-controlling interest in net assets, and then stockholders' equity, and never total liabilities. And they would sort of have this in-between category on the right side of the balance sheet. Again, if you look at most companies' balance sheets today, you'll see that they still do that, and they do not report total liabilities. It's a very strange thing. I don't think the FASB ever says you have to report total liabilities, but it doesn't say that you don't have to report it either. It's sort of the thing that should be obvious. If you're going to report, you would want to know what total liabilities is. And it's very bizarre that most companies' balance sheets do not show total liabilities. Non-controlling interest, is the calculation of this is a little complicated, but what it's basically going to be is the percentage of the sub's income that belongs to the non-controlling interest. So if the sub has $1 million in income and you own 80% and 20% belongs to the non-controlling interest, then 20% times $1 million is $200,000. That would be non-controlling interest share of net income. It's very interesting. It used to be called minority interest expense. But it's not an expense. It's not reported as an expense. You don't use the word expense. And what you're going to do is you're going to report consolidated net income at the bottom of the balance sheet. And then you're going to subtract the non-controlling interest share of net income to get the parent share of net income. Here you can see Walmart's income statement. And Walmart computes other comprehensive income in 2018, just January 31st, 2018, is $4,220,000,000. This is in millions. So it's $4,220,000,000. Then they subtract I was looking at statement of other uncomprehensive income. I'm going to come back to that. I'm sorry. So you can see here consolidated net income of Walmart is $10,523,000,000. Then they subtract 661 consolidated net income attributable to non-controlling interest to arrive at consolidated net income attributable to Walmart. Now, you might ask, when you're calculating return on assets, what do? Return on assets, you would use consolidated net income. I think for return on equity, as long as you're including total equity, including the non-controlling interest, then you should also use consolidated net income and not consolidated net income attributable to Walmart. So I think 10,523,000,000 is really your bottom line, not 9,862,000,000. Now, when they present net income per share, they use net income attributable to Walmart, to the parent, because the number of shares is only the parent shares, not the non-controlling interest shares. So this is a model of what an income statement should look like. Now I'll go back to comprehensive income. We know what comprehensive income is, I hope. I'm going to talk more about it. But it would basically be consolidated net income plus or minus any non-controlling, plus or minus the other comprehensive income items. So you can see again, non-controlling interest plays a role here, and this would be other comprehensive income minus the other comprehensive income items attributable to the non-controlling interest will give you the other comprehensive income attributable to the parent. And again, comprehensive income would go through the same calculations. The way you got this 830 here is it would be 661. This would be net income and then the other comprehensive income to arrive at total comprehensive income. And then on the balance sheet, now Walmart does this a little weird because they present the balance sheet last. Most companies do income statement, then the balance sheet, then other comprehensive income. And usually they don't do a separate comprehensive income statement. They usually do it as part of stockholders' equity. But this is nice because it's a little clearer. I want you to notice here, first of all, this is what we call the right side of the balance sheet, even though it's presented on the bottom. And the first thing I want you to notice is that Walmart does not add up total liabilities. They are like almost all other companies. They just don't add up total liabilities. And again, my theory for why they do this is because non-controlling interest used to be here, and it was unclear if it was a liability, so they just left it as one of these items, and you could decide for yourself how you wanted to do it. I think companies today don't want to do it because they just think maybe people will be tricked. They won't see what the total liabilities are. And you can see your liabilities are about 109, 115, about 124. But you got to do a little math to figure it out, which is weird. Now they add up total stockholders' equity. Now you can see your total stockholders' equity plus the non-controlling interest equals total equity. That's how they do it. What I've also seen is I've seen this just included as one more item, and they don't have the subtotal there. The non-controlling interest in a corporation can best be described as a group of disinterested shareholders who rarely vote on company issues, all employers below the manager level, C, all shareholders other than the parent company, D, a group of investors who plan to sell their stock within the next 12 months, E, none of the above. Answer is C, that happens to be right. All shareholders other than the parent company.